Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. In this week's Sector Watch report, available on getmarketscope.com, I discussed debt and dividends on recent sector price declines. Since early May, not only did sectors with the highest dividend yields fall the most in price, but they were also saddled with the highest average long-term debt-to-capital ratios. Using S&P Capital IQ's MarketScope Advisor service to select companies in the S&P 500, I found that consumer staples, telecom services, and utilities each had the highest average constituent long-term debt-to-capital ratios of 50% or higher. By comparison, the average DTC was less than 38% for all companies in the S&P 500. All other sectors had a combination of lower dividend yields and debt-to-capital ratios. 4 reasons usually are cited as to why higher interest rates typically pressure stock prices. First, they slow economic growth as consumers and businesses increasingly balk at the rising credit costs associated with expanding or upgrading. 2, they lead to increased interest expenses as long-term debt is rolled over. 3, they reduce the resulting intrinsic value of share prices from discounted cash flow models. And 4, they increase the attractiveness of bonds the higher rates rise. Well, I would add a 5th pressuring factor, that being dividends. Rising rates make the burden of paying these high yields more onerous for companies as they likely require increased payout ratios during a flattening or declining earnings phase in a slowing economic environment. S&P Capital IQ equity analysts have 103 U.S. stocks in their coverage universe with sell, 2 stars, or strong sell, 1 stars recommendations. Of these, 34 have long-term DTC ratios of 40 or higher. Finally, of these, 11 have dividend yields of 2.5% or more. I'm Sam Stovall, and I'll talk with you again next week.